Perfect. Thank you so much for that introduction. I suspect some people might still be trickling in, but in the meantime, what at a high level we were hoping to do today was to bring together a group of panelists that include entrepreneurs, that include equity investors, venture capitalists, that include mezzanine debt investors or debt investors, and development financiers. And the hope, and somehow not by coincidence, but more by design, we're all representing institutions that are focused on investing in the climate space. And so what I might ask is just to go down the row and ask everyone to just mention their name and the organization that they work for, a brief introduction, and then hopefully we'll kick off a conversation.
Hi everyone, and thank you Nijhad. So my name is Yassine Oussaifi. I'm partner within AfricInvest Group. We're a Pan-African investment platform, investing from private equity, venture capital, private credit. Myself, I've been working on venture capital and setting up a climate vehicle that we'll talk about.
Hi, my name is, can you hear me okay? Can't hear very well from up here. Okay. My name is Samir Ibrahim. I'm the founder and CEO at SunCulture. We sell and finance solar irrigation systems for smallholder farmers in Africa. We're the largest for what we do.
Hi everybody, I'm Helen Lin. I'm a partner and founding team member at One Ventures. We're a dedicated climate technology venture capital firm based out of Silicon Valley, investing globally, including in the Africa region. And my prior life, I was 8 years in Africa in microfinance as well.
Hi everyone. I'm Chirantan, go by CP, but I head up BII's venture capital team. We cover both South Asia and Africa. I'm also covering in for my colleague Emma Hawkins, who leads our kinetic facility, so I will try to make myself as intelligent in this topic, but I think the more important thing from our perspective as BII is that we, and especially from the venture team, we have invested quite a bit across the continent, across even in South Asia and Africa in the climate space, e-mobility space, and would love to kind of talk more about how we use this particular concessional capital that we have as well.
And not to hijack CP's introduction, but BII, for those who may not be aware, is the British Development Finance Institution. And finally, on my end, my name is Nijhad Jamal. I'm the managing partner of a venture capital firm called Equator, and we are a VC that effectively invests specifically in climate tech ventures, specifically at the seed and Series A stages, and with a specific focus on sub-Saharan Africa. So just to give some context here, I think, for me, being a student of, I guess, climate finance in the region for the last several years, recently this has felt like a story, or the climate finance story in Africa has felt like a story of contradictions. And so on one hand, we see tremendous tailwinds, right? So these tailwinds, these positive trends that are supporting the climate transition on the continent. We hear about natural resources. We hear about demographics that are creating an enabling environment for climate positive technologies to thrive and grow and scale on the continent. We hear about technology trends, right? I mean, cost of solar panels, cost of batteries, data, cloud computing, AI, lots of technology trends that in theory should be creating this ecosystem where capital and entrepreneurs should be really, scaling ventures and addressing climate challenges on the continent. But, and there's always a but, on the other hand, we hear some crazy statistics, right? I can tell you that in 2024, 0.6% of global venture capital went into Africa. So that's 0.5% of global VC came to the continent. And of that 0.5%, a third of that went to climate-related ventures. So not fintech on the other stage, on the other side, but a third came to climate tech. And of the third that came to climate tech, only 10 to 15% actually went into early stage ventures. And there were a few mega large rounds, later stage rounds, but really of the 0.5% globally of capital coming into Africa, a third went to climate, and less than 10 to 15% went into early stage ventures. So somehow we're hearing a story of all these positive trends, all these tailwinds, but then at the same time, the capital isn't flowing. And I'm curious, and I'm going to start off by asking Samir, I'm curious about the entrepreneurial experience of, has it been easy, has it been tough to find money, to raise money? And so Samir, as an entrepreneur in the space, you raised a mega Series B last year, $20+ million, global, local investors, sort of impact funds all the way to Silicon Valley tech VCs. Was this a easygoing, made a few phone calls, life was smooth? Were there challenges? What were the sticking points? What were the exciting points in those investor conversations as you, as a, sort of an entrepreneur building a business? Tell us the real story.
Well, it wasn't easy.
You may need to.
I'll start with that. It wasn't easy at all. My wife can attest to that. One of the things that's most interesting. So we had a party round, like you said. It was a bit of a party round. We had everywhere from sort of infrastructure, private equity investors to the founder of Netflix and everyone in between. So it was a big party round. And the hardest part is that everyone has their own almost misconceptions of risk when looking at investing on the continent. Of course there are risks, but everyone thinks that the risks are different than they are. So going and talking to a private equity investor and talking to a Silicon Valley venture investor about the risks of investing on the continent, everyone has their own stories. People are super, super poor. You're never going to be able to sell them technology. You can never lend to them. That's going to be really hard. You can't communicate with them because they don't have mobile phones. How are you going to deliver it to them? Are there even roads? Do you even have traffic? Just like the wildest questions. And for us, it was almost this repetition of data points that we have that prove people wrong. And it was almost this we have 96% collection rates. 86% of our customers have smartphones. They're using this technology, et cetera, over and over and over again. And I think the really hard part, outside of anticipating those risks and having to just share a lot of stories, is that we have to talk to a lot of people. Talking about 100 intro phone calls for an hour, and then 25 to 30 sort of deep dives into diligence. Just over and over and over again. And it's this repetition that just takes a bunch of time. So no, it wasn't easy. It was really, really, really hard. And we got it done. It was successful. It was oversubscribed. We did really well. We have awesome investors like you. I see our friends from Hisabu in the audience as well. So I think at the end of the day we got it done. But it was really just the wild thing was how far off the reality was from what people perceived it to be. Not saying that there aren't risks, but for us it was so wide.
So I guess, I think this is where I'd like to take the conversation today, which is that even the success stories about entrepreneurs and ventures that have been able to raise that type of capital, takes a long time. It was really tough. There's a lot of education. There's a lot of changing the narrative. And so ultimately, how do we crowd in more capital to these ecosystems? And how do we get the likes of Helen and CP and Yassine to write checks into companies and to support entrepreneurs in their journey? And so I might turn it to Helen next to sort of say, Helen, you help run a global climate tech fund. You're on, Fund 2, you guys manage $500 million of assets over your multiple funds. You get to look across a little bit in Africa, but yes, many other markets as well. So you're not forced to deploy money here. What does it take for you as that global clean tech investor to come? You've done 2 deals in Africa so far?
That's right.
So what does it take for you to write a check and make your third investment?
So the markets have not been kind globally in the past couple of years. So I would say what makes us get excited about investment in Africa is actually the same thing that now makes us get excited in deals anywhere in the world, in the US and Europe. It's just that it's more emphatic. It's much more, these needs are much more poignant to make the investment thesis work. And those criteria are basically things, back to the fundamentals, right? There's much less hype going on in the market here, so you can't rely on that the way you might for a Silicon Valley kind of deal. So you need commercial traction, you need sharp execution, you need a product that's so no-brainer fixes a pain point for a customer need that it's just blatantly obvious, it bashes you over the head that this is something that, it's a product that is just so needed in this place. And normally we're deep tech investors, so we invest in nuclear and we invest in all kinds of robotics and drones and crazy things. But in regions like this, our lens on technology is a bit different. Instead of deep tech and creating disruption with frontier technologies, here we look for what I call built for market tech. So how do you take those unique peculiarities of a given market, like in Kenya, and use those to your advantage? How do you take something like, oh, there might not be roads in some places, or there's tough roads and that might feel like it's a liability, but turn that into an asset instead, because maybe now you're creating something like a vehicle or whatever that's actually very well suited and customized to those harsh road conditions, because that's what people who use vehicles here deal with on a day-to-day basis, right? How do you take something like an African village and use the topology of the way huts are distributed to now create a really cool, like, mesh grid solar, kind of product? And these are the hallmark, I always say, of what makes good built for market tech in a market like Africa is it wouldn't really work anywhere else, right? You have something that would never work in New York City, would never work in London, but it works here. And that is a really strong signal that you have a team that has that deep understanding of the market and the customer needs here, and are building something that really does serve those unique needs here in a way where it is so differentiated and is that signal that, it's so much that it wouldn't work anywhere else. But you're franchising upon the huge market opportunity with serving those unique needs here. And those teams are actually rare and hard to come by. So once you spot them, they actually do stand out in the same way that a crazy deep tech in Silicon Valley might, right? It really just comes down to how well does it fit those needs they're trying to serve.
Okay, so let me be a little bit cynical. Like, you find the company that has found a product market fit and there's a big need, and so is that all you need? I mean, are you writing a check then, or? Because I can introduce you to a few people who figured that part out.
I wish it were that simple, and as my neighbor here has noted, we're much bigger pains in the butt than that, so no, we look for more than that. So back to my earlier point about fundamentals, now you have to also demonstrate execution, right? You've got a great idea, you've designed a great product or service of some sort, but now the next differentiator and the next stage gate is, can you execute? Because that's one of the perceived risks, is there are just logistical things in some of the markets here that make execution and implementation harder. So have you conquered a ground game of distribution? Have you figured out how to really convince the customer to adopt your product when, if you're serving a market where you need to raise customer awareness? Do you have partnerships? Do you have really interesting partnerships that help you crack that ground game? Have you convinced a large and entrenched player to commercially partner with you and put that seal of approval on your product market fit to say, okay, now we're going to go help you sell and distribute this product that you've designed? And this is what I mean about back to fundamentals. It's not good enough anymore in any market, but especially here, to just go and fundraise off of a good idea and a PowerPoint presentation and a song, right? You have to demonstrate that someone out there and someone of significant scale sees fit to buy this thing and put work into getting it out into the world. You have to have strong unit economics fundamentals, so you can't just say, oh, I'm relying on some kind of government subsidy or tax incentives to make my product like competitive or economically attractive. Like, no, you have to have designed something that is inherently cheap enough, performant enough, and attractive enough, all at these fundamental levels. So basically it's, as I say, like all the frill, all the hype, it completely falls away And then once you identify someone that's demonstrated that with execution and has that track record and traction, then that's the next big stage gate that I think would start pushing us into, yeah, maybe we can invest in this.
Can I make a quick comment?
Yeah.
One thing that I find
Mike.
One thing that I find interesting about that last comment is that in every other part of the world, government incentives are the global standard. So any infrastructure project, whether it's nuclear in the UK or wind in Europe or solar in the US, all has government incentives put in place. So how is that different than here?
Well, look at the US now. That's kind of falling apart, isn't it? Right? So you get someone like Trump in office, and now even in an established market like in the US, if you made an investment that was dependent on a subsidy from the government or an incentive, you're probably sweating bullets right now. And actually, because of that exact dynamic, that governments can be fickle. That subsidy and tariff and those incentives can be fickle depending on which kind of political party is in office. We, for one, and I can't speak for all investors, but we, for one, don't invest on that basis. And so if you have something, and therefore our portfolio has actually been quite insulated from something like Trump happening there, because again, it comes down to the technology and the product itself inherently was cost and performance competitive compared to incumbent technologies.
Okay, so Helen, you basically want, you don't want to take tech risk, you want proven tech, you want product market fit, you want something that scales well, you want something where the fundamentals and the unit economics make sense, you want something that doesn't rely on taking regulatory risk or subsidies. So it's kind of a long list of things that you want, and all of these entrepreneurs basically are running around trying to raise a little bit of equity to get them all the way through to that journey where you're saying, oh, but now you've got traction and product market fit and path to scale and so, you know, Yassine, as we think about climate tech, I mean, globally, climate tech is an interesting animal because basically, somewhat unlike our friends on the fintech stage, we are sometimes investing in businesses that have assets, that have physical hardware, that have the need for CapEx or for inventory or for working capital. In many of our markets, we're trying to address issues like affordability. So you think about things like pay-go lending and financing. Many of these use cases, it's tough to do all of that with equity alone and probably not get diluted to a place where you're kind of grumpy. So tell us a bit about the AfricInvest story. What are you trying to do with this new climate fund? What is the role of specifically mezz debt or mezzanine finance in this ecosystem, and you know, why are you doing what you're doing?
Yeah, thanks Nijhad. So I think it all started from our belief that in order to have a meaningful impact on adaptation and mitigation, we need to scale climate smart innovation to a certain point where they can achieve their climate objectives. So when we say that and we look at the African markets, where we see so many companies that have very positive climate impact, they've been achieving very good milestone on the profitability side. They've been developing in Africa. They've been growing, and they are at the point where they need additional funding to scale. I mean, this morning I'm sitting outside from 9 a.m. seeing an entrepreneur every 45 minutes, and I finished just before this panel, and we still have so many entrepreneurs are there. So many are at this point where they need financing that is adapted to their needs in order for them to scale. And on the other hand, when we look at the ecosystem that we have today, and we're in a journey together in building this African ecosystem, right? Starting from early stage and growing and developing different typologies of funds. Today we have a very few funds that are adapted to finance these kind of companies. So that's the idea of thinking that we had when we decided to launch this new climate fund that is a mezz fund that come at a later stage in order to finance these companies. Many of them are asset heavy, some of them are asset light, but the idea is really to bring this financing to these companies and adapt our financing to the business, to the cash flow, to the securities that they have, because we have these companies that achieved certain profitability milestones, as I said, and we want to help them grow and develop and be able to achieve their climate objectives. So this is one. The second point is that this non-dilutive financing, I think, is important for the ecosystem and for the entrepreneurs. For the ecosystem, because it allows to attract earlier stage investors, and for the company entrepreneurs and early stage investors to not dilute them and then be able to exit at valuation that are what they are, and also to be adapted to more asset heavy type of companies that require some type of financing. And from a GP perspective, it also allows to have a self-liquidating instrument that allows for the GP to get some liquidity or some certainty on the liquidity. So that's the thinking behind what we're building, and really our objective is really to have some structure financing instrument that is adaptable to the needs of the different companies that are in the market today and that require additional financing to grow and to achieve their climate objectives.
I mean, I think for me, your point, your argument about being able to mobilize non-dilutive capital to complement equity investors, to complement what the entrepreneurs are doing themselves, I think this is a critical piece of the story. Because I would imagine many of the entrepreneurs sitting in this room or in the courtyard, they are dealing with businesses that require a bunch of capital to scale. And having the right type of capital, addressing the right use case, in other words, not using equity for everything, I think that's a critical component in the journey. And as an equity investor, we're thrilled to have, the mezzanine providers coming alongside of you. And so there's, in my experience, the need for equity, for debt, even for grants and technical assistance to come in to take, risk on innovation, on experimentation, on market exploration. All of these different components have to come together to support ventures in their path to scale. And I guess on that note, CP. Okay, so some people, not me, but some people would say that DFIs are a necessary evil in this ecosystem. And some people, and again, not me, but some people would say that DFIs are a massive pain to deal with. They're slow, they're bureaucratic, they take lots of time. I could keep going, but I won't repeat what other people are saying. So what is the role in your mind that, of DFIs in this ecosystem? And when we think about, Helen, private capital, global capital, who needs to be incentivized and mobilized to come into our region. When we think about others, how does the DFI community support this whole ecosystem?
Yeah. I think, can you hear me? Hi. Hello? Yeah.
Yes.
I think the biggest success for us would be when, Nijhad, you don't need us anymore. And we've seen that across in other markets. Because we do, there is a time and place for capital like ourselves. I just want to put in perspective this talk of climate finance. So BII is obviously very much into climate finance. I think we want to be investing 30% of our balance sheet in climate finance, and even more, further. And there are larger plans that are in the offing. But I think ultimately it comes down to what business risk we're all underwriting. And I'll talk about some of the tools that we use around that as DFIs. Because if you look, you gave some interesting stats in the beginning, right, about how much money actually goes into climate. And then, folks on the other side, Moneypoint and others, we're investors in Moneypoint. I don't think the investor set in a company such as Moneypoint or any other such successful fintech business invested because, wow, they're doing great things for low-income Nigerians who don't access to money. It's completely out of self-interest. This is a great business, right? And I think we are getting to a point where climate is not just seen as a zeitgeist movement of we have to do something about it. It's now a real business. I was on an e-mobility panel, I think just a while ago, and we spoke about the fact that the TCO, the total cost of ownership, is what drives e-mobility adoption, for example. It's not the fact that people just want a car which runs on batteries. So a lot of it is coming down to how people are underwriting that risk. So when we think about the broader spectrum of climate finance, so adaptation, resilience, you have the companies in the Equator portfolio, there are a lot of instances where global investors or even other investors are thinking, I think this needs a bit more growth. That's what they want to look at. And then, so it starts to become a chicken and egg problem because the founder is saying, yeah, but I need capital to prove it. And so we constantly kind of go around this problem. What we do as DFIs is we take a view, right? Why don't we then look at the market, back a bunch of equity folks out there, right? Providers of equity capital. So in the venture capital space, so we back about 25 VC funds across South Asia and Africa. Large part of that is towards climate, and that's one stack, one capital stack, an equity stack, if you may. But beyond that, we're starting to see some kind of I wouldn't call it market failure. I think there's some gap where founders were saying, I need a bit more to test something out. It's still a bit hard. And that's where we're starting to kind of come out and think, well, what is the other product that we can offer? So we have a climate innovation facility, which we offer to our portfolio companies, where it is essentially concessional capital. But that concession capital is only there to enable. It's not there to replace. It is there to help the founder kind of solve a problem, to kind of get the adoption rate high in whatever business they're doing, so that you come to a point where others start to bite. It's like an aperitif, if you may, for private investors, where, okay, I can now underwrite this because a large part of that risk is gone. So that's something we're becoming a lot more kind of proficient around using. But we're very, very clear that this capital can also have an unintended consequence of just kind of distorting is probably a very harsh word, but trying to fund something which doesn't really need to exist. So for us, the proof point has to be, is there additional capital coming in separately or alongside? So what we've done is we've identified what is the risk that this company or investors aren't biting. Is it FX risk? We can probably solve for that. Is it scale-up risk? Can we put some in an asset-heavy subsidiary? Can we fund that by concessional capital? Is it a risk on returns, and can we boost returns? And can we then try to get others in? But more importantly, how do we demonstrate that this works? I think the demonstration effect to local banks, because I think local banks need to step up as well, to investors in the African ecosystem, especially private equity, infrastructure style investors, to start getting a bit more comfortable around the risks they're underwriting. And I'm glad that folks like yourself and AfricInvest are thinking about this mass product, because that's what's needed. And it just is there to ignite something, but it's not there to replace, it's to enable. And so we've used that product now quite successfully, and we'll continue doing it. I think we can come in at the same time as other investors, or we can kind of make the journey a bit better. So as a DFI, I think the capital stack that we're starting to see, especially in the climate space, venture funds, so equity, we have debt, project finance at a later stage, but this kind of concessional capital with Kinetic facility that we have is probably the right way to kind of right sizes. And then the hope is that we don't call ourselves climate finance. It's just genuinely good businesses, which make a lot of money, right? And do good.
So we should definitely change the panel name to Generally Good Businesses Finance Panel. But so it's an interesting story because X years ago, catalytic capital was it was basically first loss, right? I mean, it was one flavor. It was first loss, protect the downside. That's what you get. What you're talking about is actually now beginning through this climate innovation finance facility to think more creatively about how do we tailor the risk or the benefit, and what are we trying to promote to what the individual investors' challenges are. And so if it's FX, it's this, or if it's a return enhancement, it's this, or if it's a loss reduction, it's that, which I think is really interesting. But then I guess I go back to someone like Helen and I say, if you were worried about FX, we could solve that problem, would that be enough? If we were worried about, loss or downside, I mean, does this get you over the hurdle or still not yet?
Well, the annoying answer is it's kind of a case-by-case basis. Because it obviously, you look at any investment opportunity as a package and you weigh all the risks and all the potential upsides and net them off each other and make a call. So potentially yes, depending on what other risks and things are out there. But what I would say is like, how direct of a line can you draw between your tool, your financing tool, and the problem you're trying to solve? So something like FX, I could certainly believe that there would be a very direct financially engineered fix for that because it is a financial problem. Something that is about commercial traction, maybe, because, I don't know, maybe there's like a working capital lending facility that then can come in tandem with like an offtake agreement from a large B2B customer, and then that enables the execution with the working capital. So maybe something, so you get what I'm saying, but something that feels more indirectly addressing the problem, I think would be harder for that to get us over that hump if that's really a big concern, right? So how directly are you really solving the problem?
If I may,
please.
Just some of the examples we've done, right? So if you look at e-mobility financing, I think, and especially in a relatively more advanced market than such as in India, we've used this capital in a very different way. We've said, right, the manufacturer is essentially giving you a battery warranty for 6 years, 5 to 6 years. But the underwriting for that is only 3 years. So there's some mismatch happening between an underwriter in the ecosystem who is not willing to extend that. And therefore it has if you can, then you get it at a cheaper price, right? And so there's a information asymmetry happening. Now, we can just wait for that to change. Or what we've done is essentially with a particular portfolio company of ours in India, we've kind of given them this facility where we have extended this tenure for longer. So we matched the warranty. But we've also made it open-ended. So we've also agreed with the company that we will publish a lot of the battery data and all the technical data to lenders across. So it's pretty open architecture that they can actually see that the vehicle essentially works. And the hope there is that there is a demonstration effect and then they start to price it. And I'm actually quite, that's what's happening in India. And I'm quite pleased that even in the African context, you have some lenders, some of whom are actually here, who are getting smarter on that, using data to try to see if they can reprice, get a better kind of offering. So ultimately what's happening is the total cost of ownership for a rider is falling down, which is enabling the company to sell more of its products. So therefore, they're coming up the adoption curve. So I think there's more systemic. I'm a bit circumspect on FX because, beyond the point, how much can we keep protecting a commercial investor's return? So the whole idea of the SIF facility is to, hopefully form a systemic change, which will overall affect the ecosystem positively.
So if I sort of take some messages from that last conversation, it's that catalytic capital or blended finance or more sort of innovative finance can do two things. One is it can help with financial de-risking, and the other is it could end up with commercial de-risking by helping to accelerate proof points. And so Samir, as a recipient or potential recipient of this type of capital, can you give examples of how you've had to innovate on using some of these creative mechanisms outside of just equity and debt to help boost volumes, bring down improve affordability, get that commercial de-risking?
Nijhad's one of our investors, so this is quite a leading question because he knows the answer. So our business, our customers are very price sensitive. People who don't have a lot of money, there's a high degree of price elasticity in that segment of the market. And we operate in markets where there aren't government incentives like there. And by the way, I think with Mr. Musk, we're safe from the solar. We'll see what happens, but I don't think it's as bad for solar in the U.S. But we don't live in markets where there's subsidies for energy or agriculture, which is generally the global standard. And so we need to figure out a way to reduce the price of our systems to increase our addressable market and therefore increase our sales velocity. We generate carbon credits by displacing diesel and petrol pumps. And then we sell those carbon credits in both the voluntary and then very soon, hopefully, the compliance markets. And we use those revenues to subsidize the price for our customers. So the customer price drops, but our margins stay the same. Now, we were the first solar irrigation carbon project in Africa. So figuring out how to sell and finance this has been quite interesting. We worked with BII on a pre-financing facility for our carbon that gave us the capital up front to give discounts to our customers to prove that we'll get the sales velocity that we will see. And we did. We reduced our price by 28%. Our sales went up by over 4 times. And that pilot allowed us to then work on an expansion of the debt facility with BII. And then we're going to be raising a commercial carbon SPV on the back of all of that research. So BII made returns, even though it was capital they could have given away. We gave them money back at a profit. They're going to be anchoring now our SPV, and we're going to be raising commercial capital into there. And that's a really amazing example. And I think that, like, the thing that's interesting to me in all these conversations is blended finance, while it's innovative, it still is the global standard. And this isn't a new thing. The way we structured the facility with BII to pre-finance our carbon was a new thing. It was the first time this has happened in this market. We can go into details for why, but the structure was very innovative. But blended financing is not an experiment. It is a global standard. And I find it interesting that there's always this sort of innovative word before blended finance, because again, if you look at infrastructure projects anywhere, and I hate using this term, but in the global north, if you look at any infrastructure project, any road, any subway system, they all have a blended finance component. There's always equity, debt, and subsidies. We just live in markets where governments don't have the capital to be able to subsidize, so we go other places. I was on the board of the Kenya Revenue Authority for a year, and I mean, I saw from the inside how little money governments have to actually subsidize things. So the innovation here is we're going to other governments and saying, other governments, can we then use that capital to subsidize? But it's not a new thing. And I think one of the most frustrating things that I face is trying to remove that innovative word from the conversations. And I really point people towards, have you invested in real estate or any infrastructure in any parts of the world? Oftentimes they say yes. I said, great. We're using that same structure for distributed infrastructure for climate. It's not a new thing, it's the same thing. And that's been a big message that's helped people think about risk in a different way, because they're seeing that we're using the exact same tools that they've used in other investments, but it's just called different things, right? We now changed government. We've gone from incentive to subsidy to results-based financing, right? It's just literally a branding thing, and it confuses people because everyone's like, "What the hell is an RBF?" And I was like, "Okay." So it's a lot of narrative education around the actual lack of innovation we need to get something done. We actually just need to use the same tools just in this context.
Okay, so basically not climate finance, but just good business finance, and not innovative blended finance, but just blended finance or finance.
Exactly.
Okay, so we've talked a lot about finance, about capital, and I think one of the interesting lessons that I've experienced, in this journey has been that capital is part of the problem, but it's not the only part of the problem, and it's not the only solution. And many entrepreneurs in their path to scale need a bunch of other things to come together alongside the capital to ultimately generate returns and to actually attract more investors and more capital in. So there's a bit of a cycle. And so, Yassine, you've invested across the continent, many countries, but actually at AfricInvest even looked at other markets and sort of what are lessons that you have experienced or learned through some of your portfolio companies in their path to scale, that we can bring to the people listening here.
think this is an interesting question, Nijhad, and I want to take an example here of a company that has been scaling outside of Africa and that has scaled from starting in Nigeria to becoming operating on different continents. And I think Move is a good example here. First, because Move is a vehicle financing company that does lease to own and has a partnership with Uber. And I think it's a great example because through their vehicle financing, they've been able to accelerate the adoption of EVs. And in our theme, this is very important, and they've been operating as 100% EV fleets in multiple countries where they operate. This is on the climate angle, but on the scaling angle, I think what's interesting is the way they approached it, being opportunistic, but at the same time planning for what they will do, and using the competitive advantages that they have in order to scale in Europe, in the UK, in India, in the US, with the partnership they have with Maymo, and also in Latin America with their latest acquisition that they announced 10 days ago to get through an external route in Brazil, which is an interesting one. And before that, they've been operating in both Mexico and Colombia, but that was more an organic growth. So I think having all these tools at hand is an interesting way to scale and to build these champions that are able to grow and to reach the objective of building this large-scale companies. And being able to get the best of every ecosystem is key, I think, here. One good example that we have also is the example of InstaDeep in a completely different space that started, in Tunis, 5 minutes from our office, building AI tools, and then quickly expanded to Europe to get the advantages of the UK and French ecosystem, building relationship with Imperial College, with Polytechnique for their research, getting the customers, but at the same time keeping the base in Africa, keeping their offices in Tunis, building offices in other regions, in Lagos, in Cape Town, etc., in order to take the best of the different ecosystems, and this allows us to build regional champions that we can exit, that we can be proud of. I really dream of seeing more of our African companies that are able to scale outside of our borders and become champions in emerging markets and also in developed markets.
Which I think is a really interesting point, because so often we say, we're a homegrown company in Nairobi and our goal is to kind of expand across sub-Saharan Africa. The answer might actually be that the next logical market, based on customer dynamics, based on climate dynamics, based on product fit, might not be to go from Kenya to Nigeria, but it might be to go from wherever to Brazil or to North Africa or to the Middle East. And so I think thinking about, is it just a sub-Saharan African story, or is there a global story, and whether that's global, emerging markets, or developed? And then being the best in our region actually doesn't get you there, right? We have to be the best globally, because global investors are not looking to invest in the best African solar irrigation company. They're looking to invest in the best global company. So mobilizing capital to our markets, there is an interesting comment about de-risking through regional expansion, even outside of the continent. And then there is an ambition to say, how do we be the best by tech, by solution, or whatever it may be, globally, not just in the region. So kind of opening it up a bit, other examples, other lessons learned from you guys who are kind of either operating companies across multiple countries or investing across different markets. What lessons can we help share with our our entrepreneurs and people around the room here about their path to scale, and can we bring other kind of, lessons to the table?
I'll share something. It's a little bit, maybe not what's expected from a good business and not innovative financing panel, but for the entrepreneurs, I think one of the most important things that's not talked about is just taking care of yourselves. This is going to be a very long and very tough journey as you build businesses. Finding investors who are thoughtful and finding investors who are supportive is really important. They are people you're going to be working with for a long time, so making sure you take care of your own physical and mental health, and also finding investors who you can talk to about your physical and mental health, I think is really important. I know very much not related to the innovative financing panel, but I think important to talk about if there are any entrepreneurs in the room. And then more related to this panel, one thing that we found really interesting is I wouldn't underestimate the differences in markets when going from one to another. There's this, when you talk to investors outside of Africa, the continent, there are a lot of investors who are looking for an Africa play because that's sort of in their mandate. There are investors who are looking for an emerging market play as well. But I wouldn't, just because people are talking about Africa as one whole market, I wouldn't underestimate the differences between Kenya and even neighboring countries like Uganda, or especially going to West Africa and different West African countries. The product you may need to launch in each of those countries may actually be different. Like our product in Ivory Coast is a different product than what we have in Kenya, and we've actually had to develop new products to serve that market. So I very much believe in single country risk, so diversifying your revenue streams, very important. I do very much believe in FX risk, so figuring out how some hard currency revenue is very important. But I also just don't think it's just that simple. I would spend a lot of time before putting a lot of money into a new market, specifically understanding customer needs and product market fit. Your business systems will likely scale. Your management and the way you operate your company will likely scale. Your culture could scale, but the thing that you might think is the easiest thing to scale, which is your product, might not scale. So I would spend more time on that and less time on figuring out how to redesign your back-end system to work in a new market, because it probably will work.
Yeah. So many lessons learned, it's actually kind of hard to pick. Pick one. I think we all have a bunch of scars that we call lessons. But I would say, thematically, keeping with some of the earlier discussion, is don't underestimate the value of pulling commercial levers for bolstering cash flow. It isn't always about external injections of capital. And actually, if anything, if you come off of, as an early stage company, as being solely reliant on external capital injections to scale, that's a turnoff for investors. You have to show that you're helping yourself as before you go with your hand out asking for money from external, and even your innovative blended investor types, right, who may be more open-minded. And so when I say commercial levers, back to fundamentals again, right, it is, go build that supply chain in a way where you have suppliers that might give you good terms and supplier side financing. Go get that offtake agreement where you can get a 50% deposit paid up front to help cover some of your working capital. Go partner with people on distribution and the ground game so that they incur those costs, right? To have to employ salespeople to sell the product so that you don't have to incur that cost, right? Just like there are, just a quick share, I come from a family business and my father's an entrepreneur and he bootstrapped a company up to millions of dollars of revenue. Back in those days, in the 80s, like VC wasn't even a thing. Like this is how businesses used to be built all the time, right? And so it's entirely, you don't grow as fast. And so then if the story you go out to investors is we've built all these strong commercial fundamentals, and we've bolstered our own cash flow. We've been the architects and the bosses of our own future that way. And you, Ms. VC, we just need your capital to accelerate, right? And every dollar you put in is just going to help us stomp on the gas pedal and go faster and amplify all this great fundamental stuff we've already built for ourselves. That is such a stronger message and more attractive than saying, well, we kind of have an interesting product. We haven't really completely figured anything else yet. We're running out of cash. We have no runway, and we need $10 million to buy us the time to figure it out, right? So, I mean, I'm exaggerating, but like you'd be surprised how many pitches we hear that actually come off kind of sounding that way, with unintentionally so. And you would never put money into something that feels like a black hole. You need to put money into something that feels like it's actually going to catalyze something really concrete and constructive in that business. So yeah, commercial levers. Good old-fashioned commercial levers. Don't underestimate them.
So CP, Yassine, any advice for the entrepreneurs in the room?
Yeah, I think, and Samir, great advice on mental health and just keeping it together, because I think this ecosystem is a very, it's like a village, right? You have VC investors who, by the way, have their own trials and tribulations. So everyone understands each other, and I think you just have to be very, very resilient. And how do you build resilience also shows on the company, on the culture that you're building. We have, I guess, the privilege of seeing 300, 400 companies within the funds that we manage, and also directly. That's one of the big kind of things which stick out. And to your point, being needy is such a big turnoff for later stage investors, because that just shows that you've not really spent time on your basic kind of stuff. I would say one of the things we've noticed, which is very, very important, is about the need to be creative, even around your own structure. So you built product, built everything else. What your late stage investor wants, how do they kind of underwrite to you? You need to think a bit more creatively, especially in businesses which have a lot of assets, which are asset heavy, which are not software solutions. And how do you kind of, and a lot of successful founders have done it, where they've hived it off, they've done yield cos, they've done all kinds of creative things, which is actually quite interesting for people to underwrite, because they can go, I understand this side of the business. So don't underestimate the pulls and pressures of your incoming investor and how they think, because I think you can't just assume, I'm doing the best thing and everyone else is a fool. There are different challenges and different pulls and throws of capital elsewhere. So just be conscious of that in the overall founder journey.
Yassine, last advice, and then we may open up for a question or so.
Yeah, maybe another story, of a company that we worked with, which is in the ride-hailing space. So Hitch, they started as a ride-hailing company in France, and when we invested, they were doing, I think, less than 1% of their rides in Africa and Morocco. And we invested with the thinking of bringing them to Africa, to West Africa, to the Francophone. And today, we have 6 years after, we have a profitable company that does more than half of their rides in Africa. And I think what I want to share is the way, few lessons from the way they did it. Fully agree with Samir. It's really understanding the markets, like understanding how each market is different and how it works. This is one. And then adapting to each of the markets. Like, you don't take it as it is, but tweak a bit your business model to adapt to the market. And third, you need to find the right people. This is critical, like the right person, local person that knows the market and that adheres to your culture also, because you need someone that is in the middle between the two. And then sometimes it works, sometimes it does not. So you need to build some kind of KPIs. Say, okay, at the point of time it doesn't work, we need to stop it here and then move to something else. Because otherwise you spend too much energy, too much resources in going in one direction. So that's one way they've been operating in this space in order for them to scale and to be able to achieve where they are today.
Thank you. Should I turn it to someone in the room with a question?
We have time for one very brief question, so keep it short.
Thank you very much. My name is Shamim. I'm from Tanzania, an entrepreneur, but working specifically on ocean climate. And I just wanted to ask specifically Helen and maybe all of you, what are the key barriers, especially when it comes to funding ocean climate tech compared to land-based climate tech?
Helen,
Yeah,
please.
happy to take that one on. So we look at a lot of ocean tech. We should talk. And generally, they are considered to be harder to scale. I think operationally and logistics-wise, everything is just a little bit harder to do in the ocean, right? If you're using some kind of mechanical equipment, there's a lot of corrosion that happens from salt water. If you're using something that is sensitive to kinetic motion, then you're out there on the waves. Like, those are unpredictable. As climate change gets worse, some of those, like, motion things start to become even harder to manage. I think the other issue is permitting. And so if you're trying to install anything in the ocean, you need permission, right? A lot of these ocean-based things are protected nature areas, and so now you have to go out with a novel thing no one really understands and get a permit to be able to install some random thing in the ocean. So there's just, I think, some logistical issues that make them feel harder to scale. That said, impact-wise, it's huge, right? The ocean and the earth, like the dirt, are like the two largest carbon sinks Mother Earth has, but only if they're healthy. And so if you're going to be a part of the climate change story, you have to invest in the ocean. So I think what you'll find amongst the climate investor community is there's an understanding that it's completely necessary, and from an impact perspective, it's huge and you have to do it. But then where people start to struggle is on the execution and implementation side. So if you can really show that you understand how to overcome some of those challenges in a differentiated way, and also commercialize in a venture scalable way that is not completely reliant on selling to a nonprofit, you need to show like a trajectory of revenue, which is the other challenge, is nature-based solutions often don't have that potential for that strong revenue ramp. But if you can prove a revenue model that monetizes what you're building in the ocean in a way that has that revenue ramp, I think that goes a long way as well.
Okay, so maybe just to final sentence here, and thank all the panelists, but what I'm hearing today basically is that the promise of climate impact alone is insufficient in our journey. Like, that will not get us to where we need to be. It can't just be about promises of climate impact. And therefore, we probably need some combination of equity investors, global and regional. We need some combination of mezzanine finance, project finance, traditional debt, grants, TA, carbon revenue, results-based financing, whatever we want to call it, subsidies. There is a bunch of things that have to happen to support entrepreneurs in this journey. And the hope is that the people around this room, the people outside, somehow are going to come together, collaborate, and see if we can ultimately achieve our collective mission. And so thank you for your time and listening, and thank you to the panelists for sharing some thoughts today.
Thank you.
Big round of applause.